Hello, it's Wednesday the 16th of December. My name's Brenda and this is Arthur Marshall and we're analysts with AHDB Market Intelligence. Today we're going to give you a quick update on what's been happening with the cereals and oilseeds markets. So just to start with prices, over the last month we haven't seen that many changes and prices have generally bounced around the £115 per tonne mark for UK feed wheat futures. Yesterday's closing price was £117.20. The reason why we haven't seen too many changes is we're well aware of the 2015-16 fundamentals at this stage in the season, and there hasn't been any major events throughout the world that has really caused any impact to that trend so far. For UK, we're aware that planting for next year's harvest has gone well and crops have been established well going into the winter this year. Another key thing that markets have been focusing on over the last month is changes in trade throughout the world, and particularly for Argentina. The change in the president in Argentina means that he's going to put through some export policy changes, which means that although fundamentals of supply and demand haven't changed, we're expecting to see further grains and oilseeds on the international export markets available. Another key thing that has been the focus of markets is currency, and this is particularly evident for rapeseed prices. And you'll see on the graph that UK rapeseed prices have been relatively insulated from the downward trend that we've seen for European rapeseed futures and the Matif contract. Moving on to trade, we received the latest trade data from HMRC at the end of last week, and it's showing us that the UK was still a net importer of wheat at the end of October so far this season.
So what effect might these import levels have on the balance sheet?
Well, this is something that we're going to have to closely monitor throughout the rest of the season. In October, we exported over 195,000 tonnes of wheat, but we're still seeing big imports coming in. So we really need to become more competitive to capture more export share on the international markets. Interestingly, we're still seeing considerably high levels of maize coming into the UK, so there's large availabilities of feed grains in the UK at the moment, and this is something we'll be monitoring as we go through the season to see what impact this has on the balance sheet forecasts. So Arthur, you've recently done some analysis into gross margins. How's that worked out for this season?
Yeah, so we've recently had a look at estimates of the 2016 spring cropping gross margins for the UK. This is really to give us an idea of how the incentives to plant different crops might have changed from last year to this year. So rather than being reflective of the individual gross margins on any particular farm, we're trying to use it to get an idea of who might be planting what and what crop areas or changes in crop area we might see for next year. So this might capture both people who have intentionally planned to plant spring crops and also people who might have failed to establish a winter crop and might be choosing to spring crop. The main headline, if we look at the top of the ranking, we've seen spring milling wheat overtake spring malting barley. The real driver of this is the weakness in the straw market. So for spring malting barley and for spring feed barley, we've included the value of straw, and with the weakness in that market, that's really brought down the gross margins for those two crops. So we've seen a similar relationship for spring feed wheat also overtaking spring feed barley. As these are all based on estimated prices and representative NOV16 prices, there's a lot that could change, but this suggests there might be a slightly greater incentive to plant spring wheat, but also it probably maintains the incentive to plant spring barley, given that in certain parts of the country or for some growers, planting spring milling wheat might not be a feasible option, so that could still maintain the incentive to plant spring barley.
We've recently seen in the early bird survey that we're expecting another high area of pulses next year. So what do the gross margin for pulses look like?
So the gross margins alone for pulses on this analysis don't appear particularly strong, but again this could vary by grower and vary by area. So for some growers they might be able to achieve a higher yield than we've represented here, or they might have different markets open to them. Also, the second feature about these spring gross margins, and that goes for all crops, is that they don't necessarily capture all the benefits of some of the crops. So, for example, there could be agronomic benefits to a grower, or there could be a benefit for a following crop the next year, which aren't being captured here. And also, as we know, policies can contribute towards the ecological focus area, which can allow people to achieve the greening payment. So again, that could be contributing to the decision to plant more pulses.
So as I mentioned, we haven't seen too many changes in prices, but we know they are low. Has there been any impact on input prices to the gross margins?
Yes, so all crops have actually benefited somewhat from lower input costs, lower variable costs, and that's mainly driven by a reduction in fertiliser costs compared to when we made these estimates this time last year. For some crops, such as spring oilseeds, where the markets have been relatively flat, unchanged prices more or less compared to where we were this time last year, that's actually shown up in a slightly better gross margin than where we were forecasting for this time in 2014. But for all crops, like I say, they've all benefited somewhat from that, but for most crops that's been offset by price declines compared to where we were. So thank you for listening, and I hope you found this useful. Merry Christmas.